Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. Our guest today is Mihir Vora, Chief Investment Officer of Trust Mutual Fund. Mihir, thanks so much for taking the time out and joining us. Always a pleasure talking to you. How are you seeing the current market environment, Mihir, in that there is a bit of a volatility due to some global fund selling, due to some conversations around what's happening with the election mandate, so on and so forth. How are you shaping up through this process as you invest the money for your maiden fund?
Yes. Good morning, first of all. Nice. Thanks for having me on the show. I think the markets had run up a bit, and we haven't really seen any kind of correction so far. So I wouldn't say it's it's a matter for much debate, frankly speaking. Uh, and even if you see the results season, it's been okay. The domestic cyclicals have done fine. There have been some hiccups on some of the defensives in IT, which was kind of expected. So I think I would still consider this as a normal market breather and not read too much into it. Uh, I don't think the market is so far discounting any change in the regimes. If that's the concern of the market, that has not been factored into the market, I would say. As of now, the positioning seems to be continuity of regime, and hopefully the growth path that the current regime has set out on in terms of investments, encouraging private sector as well as public sector spending. If that continues in the next regime, then I think we should see continuation of the bull run.
Um, Here, this earnings season has thrown up some clear winners, some very decent commentary, especially in the lines of something that you mentioned some months ago as well about maybe agrochem, chemical, pharma, etc. coming to the fore. But that notwithstanding, first the broad brush view. Does this give you the confidence, the earnings and the commentary, that on the earnings trajectory at least, things are sanguine, or are there some cases of worry?
Look, I think what's happened is that the domestic consumption theme seems to be, still a mixed bag, I would say, wherein the higher end consumption story is continuing. We have seen good margins, good volumes in some of those segments, and FMCG, etc., continue to, lag a bit. However, there are some green shoot even in FMCG, I would say, that some of the companies have indicated at higher volume growth going forward, though it may not be the current situation. So there are some green shoot. But if you look at the other cyclicals like financials, the banks, NBFCs, the capital companies, they have some of them have really given good results. So I'd say that the cyclical story, the investment-led story continues, including things like cap goods, defense, etc. That continues. Whereas the consumption story is slowly probably getting on back on its feet.
Okay. You are a great mind to analyze what happens onto the global macro or even the local macro and juxtapose it with what could happen to equity sentiment or otherwise. Now, we know that the global interest rate scenario is not exactly in favor currently of risk assets, because we do not know when the rate cuts start coming in. But is that now the new normal and the believed normal, that there will be no rate cuts, and therefore any postponement in the current calendar year for rate cuts, will it have an incremental negative impact, or has it been baked in already to your mind?
I think most of the discussion that we are doing is for the US economy.
Yes.
Yeah, and it probably drives the rest of the world's interest rates, etc. But if you see, the problem is that of plenty. There is too much growth, and because of too much growth, there is too much inflation out there. And as long as the growth story in the US is intact, I think the world is in a okay place. 50 basis points, 25 basis points interest rate hike, etc., should not really matter. What really matters is whether we see continuation of US growth, and by that logic, global growth. Uh, with China hopefully bottoming out, may not be the fastest growing economy, but even if China grows at 3-4%, then I think with the US tailwinds, we should be in for a good ride. For the Indian markets, where we are talking about 6.5, 7.5% kind of GDP growth, the 25 basis points rate hike really should not matter. I think what we should focus on is our own bottom-up growth story, which is to some extent linked to the global, but compared to other countries in the world, we are still quite dealing from the export story, I would say.
Hmm. Okay. Well, today some of the shipping companies are doing very well. We've had some media names coming out too. But here, unequivocally, the story has, I mean, to my mind, in the recent past few days, has been two-pronged. One, the kind of volume growth uptick that we've seen in agrochemicals, even if pricing is not in favor, and the kind of buying that we're seeing in some of the agrochemicals and chemicals, and the kind of commentary that we're seeing from some of those names. So I was looking at the commentary from an Aarti Industries, from UPL and some others, and there seems to be some confidence that there might be a bottoming out procedure in place. The EBITDA guidances for some of the companies are also very strong. You were amongst the first ones to say that at some point of time the tide will turn. Is that now looking a lot more convincing for chemicals, specialty chemicals, agrochemicals?
Yes, I think slowly, not very sharply. Uh, the China dumping still kind of is an issue in some of the cases. So I would not kind of take a completely, bullish call. But what I would bet on is that our 4, 5, 6, 7, top companies are now really world class in terms of scale, and a lot of them have good growth plans already announced and under implementation. So I would say a little bit of margin compression, but significant volume growth. That would be the call I would take for the next few years for these companies. And if that's the call, I think valuations are kind of okay. They're not very expensive anymore because we have seen almost 1.5, 2 years of correction and consolidation in this segment.
But because you're not forced to buy this segment due to index representation or otherwise, are there better options out there, or is this also a good option uh, despite the margin compression that you spoke about?
Some of the companies are really big in scale, and they are global in size. So they should not be ignored. And if valuations are attractive, which they are at this point in time, there is a case to, at least take a serious look at this segment.
Okay. The other aspect is the revival of the rural basket. Now, there is some commentary out there, very selective in that has come in. I mean, Pidilite, of course, said that they've done this, now seen this for last 3 quarters, but some of the staple companies also cited to that possibility. Have you examined this, Mihir, and do you believe rural-focused companies merit a look at, or is it a bit uncertain currently?
See, the low ticket items, the FMCG packs are still under question mark, I would say. I would not. I mean, well, as you rightly mentioned, the companies have given some hope for the next quarter. But you know, again, stepping back, if we are saying that the election results will be out in the next few weeks, and if there is no change in regime, then I think the more excitement will be on the next 100 days. What kind of policy announcement that we see. So for the next 100 days, I don't think FMCG will be that exciting if there is no change in regime. Yes, if there is market downturn, the sector might outperform, relatively speaking. It might fall lesser than the rest of the market. But if you are talking about a positive market, then I don't think this will be a very exciting sector to be as far as the low ticket FMCG is concerned.
Okay. Um, I'm just dialing back to autos, Mihir, for a bit, because that was the other sector that stood out in terms of earnings this time around. The only question is, what did you make of the commentary that came in from Tata Motors, wherein they guided to the possibility of maybe lower volumes in the domestic PV business because of heat wave or elections and a high base effect, or even the commercial vehicle segment, wherein they have cited the possibility of the election season dampening the near-term demand, and therefore what could happen. I mean, the stock took a big tanking in trade yesterday. But one, what do you make of that comment? And two, what is holding true for Tata Motors? Will it hold true for some of the other passenger vehicles as well? The arguments around heat wave and election and so on and so forth.
See, if I were to take a 1 year view or 3 year view, it should not matter really. Maybe it matters for this quarter. By the way, this quarter also has the least number of weddings because of the calendar or astrological situation. So you may see some of those impacts playing out because marriage is a significant occasion for a lot of consumer discretionary buying. A lot of segments, even including two-wheelers, etc., do depend on marriages. So, but if you were to take a financial year view or the next 3 year view, I don't think it should matter too much. Especially in two wheelers, we are at volume levels which are barely, in most of the cases, barely above pre-COVID levels. So we are almost at volumes which are there 3, 4 years ago. So there's a lot of catching up to be done in this segment, frankly. And if we are talking about the rural economy, at least gradually coming out of the COVID damage now, then there is a lot more, tailwind and a lot more runway for the two-wheeler segment. Uh, in autos, also one big point is that companies themselves individually bottom up can make a lot of difference. Model launches can make a lot of difference to companies. One blockbuster can carry you for 2, 3, 4 years. So I don't think companies should hide behind the macro. As long as they have good models and closer to the customer, good service, there is enough scope for growth and penetration in India.
Got it. Mihir, my final question, and the theme of your fund, if I'm not wrong, is watching companies grow from small to big or from big to very big, right, in some sense. So within the current landscape, when is it that you think that if you look at the next 5 years, where is the largest growth opportunity from where these companies might be right now?
Many segments, and some of them we already discussed many times. But again, assuming that there is no change in regime and we continue with the growth policies, then physical asset creation is one of the biggest plays that is there. Whether we talk about infrastructure, real estate, or even private sector capex. I think we've barely scratched the surface. We've talked about all the tailwinds that we have in terms of demographics, plus the government incentives, etc. So some of these companies, especially when we're talking about import substitution and then going in for exports, can have a very long runway of 5, 10, 15 years. Defense, as we have discussed so many times in the past, we have barely scratched the surface, and we had one very large company, announcing very good export orders. So that trend is also starting. And when we compare the local market to the export market, the potential can be multiple times. So there are many such stories in physical asset creation, I would say, both for import substitution as well as for exports, that are going to pan out in the next few years. Including the ones that we discussed, like chemicals and pharma, which are already there. But the real hardcore physical manufacturing plays and infra. So that's one. And second is, I think, the rising income levels and higher income categories. So when we talk about the consumer, I would still have a long-term focus on premium consumption, and that can be across segments, not only one or two segments. But when we just discussed FMCG, I would say lower ticket consumption will continue to grow at a lower pace, because I think the purchasing power at the higher end is growing faster. So segment-wise, the growth rate will be much higher in the premium consumption space.
Got it. Mihir, always a pleasure talking to you. Thank you for taking the time out and being with us on Talking Point.
Always a pleasure. Thank you.
Thank you. And take a quick break. Back with the management of BOB.